Welcome and thank you for joining me today. I am really excited because we are going to explore a trading strategy that is simple to use and, more importantly, it works. By the time we are done, you will understand how to use moving averages to identify trends, choose the best times to enter and exit trades, and give your trading performance a real boost. Whether you are new to trading or just looking to sharpen your skills, this is a strategy that can help you make better, smarter decisions. I think you are going to love it. So let us get started. Do you ever feel like the market is just a maze of confusing price movements? You are not alone. Many traders feel overwhelmed by the constant ups and downs on a price chart. But what if there was a simple way to cut through the noise and really understand what is happening? That is where a simple moving average comes in. Before we dive into the strategy itself, let us first break down what a simple moving average actually is. The concept is easy to grasp. A simple moving average calculates the average price of something over a period of time, like 10, 20, or 50 days. It smooths out the price data so that you are not overwhelmed by the day-to-day fluctuations. Instead, it gives you a clearer, bigger picture of the market's overall movement. It helps us determine if prices are generally trending upwards, downwards, or staying flat. In addition to using simple moving averages, understanding chart patterns can give us even more insight into what is happening in the market. Chart patterns are formations that appear on a price chart and can help us predict future price movements. Some common patterns include head and shoulders, double tops and bottoms, triangles, and flags. The head and shoulders pattern is one of the most well-known reversal patterns. It signals that a trend might be coming to an end. It has three peaks, with the middle one being the highest, which looks like a head, and the two on either side, which are lower, representing the shoulders. When you see this pattern forming, it might mean that the market is about to change direction. Double tops and double bottoms are also important patterns that help us understand when the market might be changing direction. A double top looks like the letter M. It happens when the price goes up to a high point, drops down, and then climbs back up to the same high point again before falling once more. This often means that the price has hit a ceiling it cannot break through, and it might start going down. A double bottom is the opposite. It looks like the letter W. The price falls to a low point, then rises, and falls back to the same low point again before moving up. This tells us that the price has found a strong floor, and it may be ready to start moving higher. These patterns can be really helpful in showing us when a trend is ending and a new one is beginning. Triangles are continuation patterns that show a pause in the current trend. There are three types: ascending, descending, and symmetrical. An ascending triangle has a flat top and an upward sloping bottom line, indicating that the price might break out higher. A descending triangle has a flat bottom and a downward sloping top line, suggesting the price might break lower. A symmetrical triangle has two converging trend lines and can break out in either direction, so it is important to watch for the breakout to determine the next move. Flags are another continuation pattern that often occur after a strong price movement. The price will consolidate in a small, sloping channel that looks like a flag on a pole. If the prior movement was upward, this flag suggests the trend will continue upward after the pause. Recognizing these patterns can help you anticipate market movements and add another layer of confidence to your trading strategy. By combining simple moving averages with chart patterns, you can have a better understanding of where the market is likely to go next. A simple moving average is like taking a step back and seeing the forest instead of just the trees. It is really useful for seeing which direction the market is moving, so you do not get caught up in the daily noise and make decisions that you regret. We want to make sure that we are on the right side of the bigger trend. To complement the moving averages, recognizing chart patterns can greatly enhance our understanding of market behavior. These patterns can give us a visual clue about what might happen next, making it easier to decide whether to buy, sell, or hold. Let us take a closer look at a few more key patterns in a way that anyone can understand. One of the most common patterns is the *** support and resistance ** pattern. Support is like a price floor that the asset does not want to drop below, while resistance is like a price ceiling that the asset finds hard to break through. Imagine a ball bouncing between the floor and the ceiling. The price behaves in a similar way. If the price breaks through resistance, it often keeps climbing higher, and if it breaks below support, it might keep falling. Knowing where these levels are helps you decide when to enter or exit a trade. Another useful pattern is the ** triple top and triple bottom **. A triple top occurs when the price reaches the same high point 3 times and struggles to go any higher, which means it may be about to fall. It is like when you try to push a heavy door open and it just will not budge. Eventually, you give up and let it close. A triple bottom is the opposite. The price falls to the same low point 3 times and it refuses to go lower, suggesting that it may start rising. This pattern is a good way to see when the market might be reversing direction. Then there is the ** rounded bottom ** or ** saucer bottom **. This pattern looks like a shallow bowl and shows that the price is slowly finding support and gradually starting to rise. It suggests that the market sentiment is slowly shifting from negative to positive. Think of it as a plane that has finished descending and is starting to climb back up again. This pattern can signal a longer-term trend reversal, giving us confidence to buy. ** channels * are also a common pattern that can help us understand market movement. A channel is formed when the price moves between 2 parallel lines, either moving up, down, or sideways. If the channel is moving up, it is a sign that the market is trending higher, and if it is moving down, the trend is lower. When the price touches the top of the channel, it often falls back down, and when it touches the bottom, it often bounces up again. Trading within channels can be helpful for setting targets, buying near the bottom and selling near the top. The ** ascending and descending triangles * are also useful. An ascending triangle has a flat top and an upward sloping bottom. It means buyers are getting stronger, pushing the price higher until it breaks through the flat top. A descending triangle has a flat bottom and a downward sloping top, which shows that sellers are becoming stronger until the price breaks below the flat bottom. These patterns can help you see who is winning, buyers or sellers, and whether a breakout might be coming. By understanding these additional chart patterns and watching for them, we can improve our ability to predict what might happen next in the market. You do not need to memorize every pattern, but getting familiar with these shapes can help you make better decisions. The more you look at charts, the more you will start to recognize these patterns, and over time, they will become like signposts on the road, helping you understand where the market might be headed. The ** cup and handle ** pattern is a bullish continuation pattern. It looks like a teacup where the cup is a rounded bottom and the handle is a small pullback after the cup has formed. The cup shows a period of consolidation, and the handle indicates a slight retracement before an expected upward breakout. When the price breaks above the handle, it can be a good buying opportunity. This pattern is often seen in uptrending markets and suggests that the current trend will continue. Another important pattern is the *** rising wedge ** and the ** falling wedge **. The rising wedge is a bearish pattern that shows the price consolidating between two upward sloping trend lines. Although the price is making higher highs and higher lows, the movement is losing momentum, which often leads to a bearish reversal. The falling wedge, on the other hand, is a bullish pattern. It shows the price consolidating between two downward sloping trend lines, which often indicates a reversal to the upside once the price breaks above the upper trend line. The ** pennant * pattern is similar to a flag, but is shaped like a small symmetrical triangle. After a strong movement in price, the market tends to pause and form a pennant. This pause often leads to a continuation in the direction of the previous trend, and a breakout from the pennant can provide a good trading signal. Pennants are important to watch because they help confirm whether the current trend is likely to resume. ***, rectangles ** are also important patterns to look out for. A rectangle forms when the price moves between a horizontal support and resistance level for a period of time. It is essentially a range where the price is consolidating. When the price eventually breaks out of the rectangle, it can indicate the beginning of a new trend. A breakout above resistance signals a bullish move, while a breakdown below support suggests a bearish move. Being familiar with these additional chart patterns helps us to further understand market psychology and gives us more tools to make informed trading decisions. Combining these chart patterns with our simple moving average strategy allows us to identify potential entry and exit points more effectively and gives us the confidence we need to act decisively in the market. All right, let us get into the basic setup for this strategy. It is built on two simple moving averages. One is a short-term moving average, and the other is a long-term moving average. For this example, we will use a 50-day moving average for short-term trends and a 200-day moving average for long-term trends. The short-term moving average will respond faster to price changes, while the long-term moving average is a bit slower and gives us a more stable, less noisy signal. Most trading platforms make adding these moving averages to your charts very straightforward. You simply go to the Indicators section, select the Simple Moving Average option, and then set the time period. For the short-term moving average, use 50 days, and for the long-term moving average, use 200 days. Once you add them to the chart, you will see two lines that move along with the price. The short-term moving average will be quicker to respond to changes, while the long-term moving average moves more steadily. These two lines are going to help you understand whether the price is trending up or down, and they can also help you decide when it might be a good time to buy or sell. Watching how these two lines cross each other can give you an idea of when the market might be changing direction, making it easier to make a confident decision. Here is the fun part. Now that we have our two moving averages, we can use them to find trends. One of the most popular signals traders look for is called the golden cross. This happens when the short-term moving average crosses above the long-term moving average. It is a signal that the market is likely shifting from a downtrend to an uptrend, and it could be a great time to consider buying. The golden cross is a very strong buy signal, and many traders pay attention to it. The opposite of the golden cross is called the death cross. This is when the short-term moving average crosses below the long-term moving average. This signals that the market might be starting a downtrend, and it is often a sign to sell or avoid new positions. Let me give you a clear example. Imagine you are looking at a stock chart and you see the 50-day moving average crossing above the 200-day moving average. That is a golden cross, and it suggests that the stock might be entering a bullish phase. On the other hand, if you see the 50-day moving average crossing below the 200-day moving average, that is a death cross, and it tells us that the price could be heading lower. So how do we use these signals to actually enter and exit trades? The golden cross is our cue for an entry point. When the short-term moving average crosses above the long-term moving average, that tells us a bullish trend is developing and it might be a good time to buy. But it is important not to jump in too quickly. Wait for the price action to confirm the trend. We do not want to fall for a false signal, so let us make sure the move is real. In addition to moving average crossovers, chart patterns can help confirm the best entry and exit points. For example, if you see a golden cross forming along with a ** cup and handle ** pattern, this adds extra confirmation that a bullish breakout is likely. Similarly, a ** double bottom ** pattern forming alongside a golden cross can give more confidence that the trend is reversing upward. For exits, we can also use chart patterns to provide added clarity. If you see a death cross forming at the same time as a ** head and shoulders ** pattern, it is a strong indication that the market is about to reverse, making it an ideal time to exit and lock in profits. A ** rising wedge ** pattern forming as the short-term moving average crosses below the long-term moving average can also signal that the upward trend is losing steam, suggesting that it might be time to get out of the trade. By combining moving average signals with these chart patterns, we can improve the accuracy of our entries and exits, helping us avoid false signals and make more informed decisions. When it comes to exits, the death cross is what we are watching for. If the short-term moving average crosses below the long-term moving average, that is a sign that the trend could be reversing. That is a good time to think about locking in profits or cutting your losses. Remember, trading is not just about making money. It is also about protecting the money you have made. Speaking of protecting your trades, always make sure to set a stop loss. A stop loss helps limit your losses if the price goes against you. You can place your stop loss just below a key support level or slightly below the long-term moving average. This way, if the trade does not go as expected, your loss will be limited and your capital will be safe for another opportunity. Now, I want to talk about how to make this strategy even more accurate. A great way to do that is by using other indicators along with the simple moving averages. One of my favorites is the Relative Strength Index. The Relative Strength Index tells us whether an asset is overbought or oversold. If you see a golden cross and the Relative Strength Index is below 30, it means the asset might be oversold, which makes the buy signal even stronger. It is like having extra confirmation that the timing is right. Another powerful tool is the Moving Average Convergence Divergence Indicator. If you see a golden cross and at the same time the Moving Average Convergence Divergence shows bullish momentum, it is a really strong signal that the trend is real and likely to continue. And let us not forget about volume. When you see a crossover, check the volume. If the volume is high, it means there is a lot of interest, and the move is likely to be real. If the volume is low, the signal might be weak. One of the great things about this strategy is that you can adjust it to fit different trading styles. For day traders who like to make quick trades and catch shorter moves, you can use shorter moving averages, like a 10-day and a 20-day moving average. These shorter moving averages respond faster to changes in price, which is crucial for capturing quick swings. In addition to moving averages, day traders should look for short-term chart patterns that indicate where the price is likely to go next. For instance, day traders often rely on patterns like ***, bull flags ***, and ***, bear flags ***. A bull flag happens after a sharp move up, followed by a slight downward or sideways move, looking just like a flag hanging off a pole. This often means the price is resting before making another jump higher. A bear flag is the opposite. After a sharp move down, the price pauses and moves slightly upward or sideways before continuing the downward trend. Recognizing these patterns can help day traders catch the next move, whether up or down. Another useful short-term pattern is the *** triangle pattern ***. This pattern shows a pause in the market as traders try to decide where to go next. When the price finally breaks out of the triangle, it can signal a strong movement in that direction. Triangles can be ascending, descending, or symmetrical, but the key is to watch for a breakout that suggests the market is picking up momentum again. Understanding these patterns can help day traders make quick decisions with more confidence. For day traders, it is also helpful to recognize patterns like ***, bull flags ***, and ***, bear flags ***, which are short-term continuation patterns that can signal whether the current move is likely to continue. A bull flag forms after a sharp upward move with a small consolidation that looks like a flag on a pole. When the price breaks out of the flag, it is often a sign that the uptrend will resume, providing a potential entry point. Bear flags are the opposite and indicate a continuation of a downtrend. For swing traders who want to hold positions for several days or even weeks, you might want to use a 20-day and 50-day moving average. This setup will help you catch those medium-term trends without being too reactive. Swing traders should also pay attention to patterns like ***, double tops ***, and ***, double bottoms ***, as these are strong reversal signals. A double top signals that the price may have reached a resistance level twice and is struggling to break through, indicating a potential downward move. Conversely, a double bottom shows that the price has found support at a certain level twice, suggesting a reversal to the upside. For long-term investors, the 50-day and 200-day moving average setup works best. It is slower but helps you see those big trends that are key for making long-term decisions. Long-term investors can benefit from recognizing patterns such as the ***, head and shoulders ***, or ***, inverse head and shoulders ***, which indicate a major reversal. The head and shoulders pattern suggests the end of an uptrend, while the inverse head and shoulders signals the start of a new upward trend. Long-term investors can also look out for ***, symmetrical triangles ***, that can signal significant breakouts in either direction, depending on where the price breaks from the triangle. By understanding these chart patterns and adjusting the moving average settings to your trading style, you can improve your ability to enter and exit trades effectively. This flexibility allows you to make the most out of different market conditions, whether you are a day trader, swing trader, or long-term investor. Now I want to share some common mistakes that traders make when using this strategy so you can avoid them. The first mistake is ignoring other factors. Some traders rely only on the moving average crossovers and forget to consider other parts of the market, like news or other technical indicators. Always consider the overall market environment, or you might end up getting caught by false signals. Another mistake is overtrading. Some traders jump in and out of trades based on every little crossover, even when it is not significant. Patience is very important in trading. Wait for clear and confirmed signals before making a move. This will keep you from making unnecessary trades and risking your money for no good reason. Finally, do not forget to use a stop loss. Even with the best strategy, the market can always move against you. Stop losses are there to manage risk and protect your capital when things do not go your way. Always have a plan to protect your money. Before you start using this strategy with real money, it is a very good idea to practice in a demo account. A demo account allows you to try the strategy in real time, but without risking any real money. This helps you get comfortable with the signals and learn how to respond before you put real money on the line. Also, track your trades in a journal. Write down which setups worked well and where you could improve. By reviewing your trades, you will be able to make the strategy fit your trading style even better. Let us take a moment to recap everything we covered today. We talked about using two simple moving averages to spot buy and sell signals. When the short-term moving average crosses above the long-term moving average, that is the golden cross, and it signals a buying opportunity. When the short-term moving average crosses below the long-term moving average, that is the death cross, and it signals it might be time to sell. We also explored a variety of important chart patterns. We discussed reversal patterns like the ***, head and shoulders ***, double tops ***, and ***, double bottoms ***, that help signal when a trend may be changing direction. We covered continuation patterns like ***, triangles, ***, flags, ***, pennants, and rectangles that help us understand when the market is likely to continue its current trend. We also looked at specific patterns like the *** cup and handle ** for bullish continuation and ** rising and falling wedges ** that signal potential reversals. Moreover, we learned how combining these chart patterns with moving average signals and other indicators like the relative strength index, moving average convergence, divergence, and volume can improve the accuracy of our trades. By using these tools together, we can make more informed and confident trading decisions. And most importantly, we talked about always managing risk with stop losses. Managing risk is key to long-term success in trading, as it helps protect your capital and ensures you can keep trading even if a few trades do not go your way. The simple moving average strategy is a great tool for traders at all levels. It is simple, easy to understand, and with practice can really help you spot trends and make better trading decisions. I hope you found this helpful and that you are excited to practice and refine this strategy for yourself. Trading is a journey, and each day is a chance to get better. Stay curious, stay disciplined, and keep working on your skills. Remember, the more you learn, the more confident you will become. Thank you for being here, and good luck with your trading journey. I would love to hear about your experience with this strategy or answer any questions you have. Keep learning, keep practicing, and keep growing.